Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Dominique. It's fantastic to have you on the podcast show.
Well, thank you, Bilal, for having me on that great platform.
Great. Now, we're at the start of 2025, obviously. You know, we have some upcoming data, payrolls, and so on, but we won't get too bogged down on the minutiae of that. Instead, I wanted to ask you for your bigger picture view of growth, the Fed, inflation, and so on for 2025, and where you think consensus is wrong. Now, before we go into that, obviously, one big input people are using for their views on the US economy is Trump. And of course, we had Trump 1. In the 2016 period. Now we have Trump 2. So in your view, what do you think we've learned so far since Trump's election towards the end of last year until now on how he's going to be different to Trump 1? How's he going to be similar? And what are the key policies you think that we need to think about that will have an impact on your macro view?
So there is no question that this time around he's better prepared, right? The first time around, I don't think he really expected to win. The issue is that there is still quite a lot of uncertainty on what he is actually planning to do. So key uncertainties, the budget deficit. Is he going to do budget neutral tax cuts? Another uncertainty is the tariff. We don't certainly he believes in tariffs more than he did in the first term. In the first term, they were fairly limited, but voters reacted fairly positively. And so that, I think, has given him a greater faith in tariff. But we still don't know whether he's going to use them as a bargaining tool or whether he's really going to implement across the board tariff, which in my view would be quite negative. He's going to do deregulation. To be honest, I think in terms of increasing productivity, I see more scope for AI, for instance, to be a factor than deregulation. It's a big theme, but it's very hard to measure. It plays over, as the impact is hard to measure, it plays over a long period of time. Okay, so he's going to do deregulation. The other one where I think there is actually less uncertainty is immigration. I think the plans to deport, so he's talking about 20 million illegal immigrants. I think those are not going to happen. It's too difficult logistically, legally. Also, many illegal immigrants actually have prospered, become small business owners, pillars of their community. One reason Trump won is a shift in the Hispanic vote. And if he starts deporting those people, he will just, lose an important constituency. And it doesn't make sense economically. If you think of where illegal migrants work in the US, in food, meat processing, construction, I mean, come on, we need food in the shelves of our stores. So the big decrease in the stock of migrants, I don't think is going to happen, but what I think is going to do is clamp on the inflows, because despite the Biden administration tightening the border, we still have a sizable number of people coming in, and that I think is going to clamp. So in immigration, paradoxically, that's where I see the least uncertainty.
Okay, great. No, that makes sense. Now, on US growth, I have to say there seems to be a lot of optimism around US growth. Part of it is the Trump factor, but a larger part is just the data simply has been very strong in the US, especially in Q4 of last year. So when you look at bank forecasts for 2025, people have been steadily revising up their forecasts. When you read investment reports, people are generally, the consensus view is that US exceptionalism will continue. What's your view on growth?
So there is a basis for people turning optimistic. First of all, let me stress that initially I think they were far too pessimistic. They were predicting sub 2% growth, which to me never made sense. Also, in terms of news flow, something that has become clear this year, and I don't think was expected, is a pickup in productivity, in the sense that we've really seen a disconnect between growth remaining strong and employment actually slowing down. And that pickup in productivity, I think, is real. It's just businesses adapting to the labor shortages during the pandemic and keeping this new technique in place because the labor market is still tight, still difficult to find new workers. So there is that. I think we're starting to see a little bit the beginning of the impact of AI. So that I think is real. On the other hand, there is another factor which I don't think is priced in, which is as the administration cuts down on the inflows of immigrants, the employment data is going to be more and more driven by demographics, and they are not great. The population is aging. Before the pandemic, the CBO had predicted NFPs around 50,000 a month in 2025. You look at other demographic projections from the UN, for instance, it's not that far. Their projections are consistent with 70K a month. So I think what's going to happen is that we're going to slow down from growth in private non-farm of about 150 this year to about probably 80 in the fourth quarter of 2025. So we're going to have a decline in the pool of people that can be employed, and I think it's going to slow down growth from currently about 2%, 2.75% to, I think, 2.25% to 2.5%.
That's for growth, you mean? That's
for
your forecast for growth. So just be clear then on the payrolls point. That was a really interesting point. You're essentially saying that demographics, especially with less immigration, means that payrolls naturally will just start to fall down towards 70,000 to 80,000 over the course of the year, down from 150,000 or so from last year. But the way you were saying it, that doesn't necessarily mean that the US is necessarily slowing down into a recession, even though payrolls is going to be falling.
No, absolutely. And that's super important because it will be a supply-driven decline in employment, not a demand-driven decline, which means that the job market will remain tight with risk to inflation. And so it's a decline in employment that the Fed won't be able to react to.
Okay, yeah. And so I guess what will end up happening with market participants, investors, will be they could be incorrectly assuming the decline in payrolls is a sign of a recession because they've incorrectly diagnosed why payrolls has been falling. So that's going to be one of the interesting risks for this year, people misinterpreting payrolls. But then on the flip side, as you say, is productivity stronger. So we lose on labor supply, but we gain on productivity. So in the end, growth ends up not collapsing on a sort of potential growth perspective.
Absolutely. And also the fact that labor will remain scarce, and this is already happening actually in occupations like air traffic controllers. There is literally a shortage of people who are qualified to do this job. There are a few key occupations. So this is going to add incentives to businesses to become more productive. So who knows, we could even have an acceleration in productivity.
I wonder if AI can do air traffic control or not. Maybe that's the solution to the scarcity there.
Not yet.
No. Now the other big topic is really inflation. So the narrative over the last few years has been we've had this surge in inflation. It's been falling. It may turn out to have been transitory, to use that loaded term. But if you look at the numbers, we haven't fallen down to 2% yet. So what's your expectation for inflation this year? What's your understanding of where we are in terms of inflation dynamics?
So the sort of a short, there is a short and a long-term answer, and I think for markets the long-term answer is perhaps more important. But the short-term answer, I think inflation is stuck largely because of capacity pressures that you can see, for instance, with the widening of the external deficit, the still very tight labor market. So I think that's going to put a floor under inflation. But there is another issue which is perhaps more important, which is, have we changed inflation regime? Have we moved into a regime with higher inflation? And I think we're starting to get signs that this is happening. So first, as you mentioned this morning in our webinars, market measure of R-star has gone up significantly. Then if you look at the structure of inflation, the Fed is telling us that we are on track to come back to where we were before the pandemic, but we are not. I mean, it looks like goods price deflation is ending. Services excluding housing inflation is stuck, really. Housing inflation, of course, remains high. We have an issue with housing shortages. So
actually, just on that housing, I mean, many people have looked at shelter prices, housing prices, and that series has been falling. And so people are saying that that's going to continue to fall. Or at least the Fed is saying, or implying that they think it's going to continue to fall. What do you think on that?
I think it's fair, but the question is not just whether it continues to fall, but whether the combination of housing, non-housing services, and goods is enough to bring inflation back to the target. And if you look at the data, it doesn't seem so. I mean, the fall in housing inflation is offset basically by non-housing services remaining stuck well above target, and by the end of the goods price deflation. So there is that.
I mean, so it sounds like so every time one component goes down, another one goes up.
Well, yeah, and we have a Brazilian client who told me something that really remains in my mind, which is, in his experience, when central bankers face inflation above target, their first reflex is to do what he called slice and dice, cut it in components and then find a good story to tell about each component. I mean, fair enough, but the bottom line is, core PCE is still 2.8%, despite all these nice stories that the Fed has been spinning. So another sign of change in regime is that the Fed funds rate is now back to the Taylor rule. So the Taylor rule, it's a kind of back envelope calculation to compute where the Fed funds rate should be based on where inflation and unemployment are. And so we are back. We are back at the Taylor rule, and the Fed has announced that, they are pausing cutting. And in my view, they are done with cutting. While before the pandemic, the difference, the Fed funds rate on average was well below the Taylor rule. So it could be that we will need a structurally higher Fed funds rate to keep inflation stable. And one last element that is worth mentioning is the comeback of supply factors. In both the San Francisco decomposition of core PCE, supply factors are actually more important than demand factors, even though if you look at the New York Fed index of supply bottleneck, it's back to normal, back to where it was before the pandemic. And the St. Louis Fed has just published a decomposition of core PCE based on a structural macro model. And they also show a growing importance of supply factors. And in those supply factors, interestingly enough, you have prominently an increase in wage and price markup, meaning that both workers and businesses are starting to try to increase their margin, increase their the real wage, and increase prices relative to cost, which points at an increasing conflict over the distribution of income, which in my view is, the core view of inflation. And that is very consistent with Trump winning and the Republican winning, in my view, largely because real incomes, real wages had fallen during the pandemic. And basically, for 30 years, we've had stagnant real wages, or real wages have increased by much less than productivity. So it could be that politically, this decade-long trend that we've had of a decline in the in the wage share of income, the labor share of income, that it's no longer politically sustainable. So unions are regaining prominence. Strikes remain higher than before the pandemic. And so we could be going into a period of conflict over the distribution of income. And in my view, that will require a higher Fed funds rate to keep inflation stable.
And when you say higher Fed funds rate, what's your expectation for this year?
So for this year, I see no change, no cut. But no hikes either, because inflation is a slow-moving variable. So even if inflation perks up, the Fed is going to take its time to react. Powell last year told us that he was aiming to keep inflation within a range. I think the range is about 2.75% to 3%. And if inflation moves outside of that range, the Fed is first going to announce that they give up on their easing bias, and then only then the rate hikes will come. So to me, the biggest Fed risk this year, an end to the easing bias, but more in H2, perhaps Q4. I mean,
Okay.
unless, of course, we get like an oil shock or, a very inflationary shock.
Yeah. And of course, markets are expecting rate cuts for this year. Most banks, most analysts and economists are looking for cuts. So you have a non-consensus view, there. In terms of the Fed's thinking, then, I mean, is there a chance that the Fed will start to lose credibility around inflation?
Inflation is a slow-moving variable. I mean, in my view, the problem is when inflation moves up, the Fed changes its end-year SCP forecast. So I think there is already a risk of a loss of credibility. And we've been with inflation above target for 4 years now, nearly 4 years. So for sure, the longer you stay there, the longer the risk of a loss of credibility. Would it show up? I guess we would see it in inflation expectations. And actually, if you look at the University of Michigan long-term inflation expectations, they've already moved up and they've not come down. I mean, it's not very visible because this is a low volatility indicator compared to the short-term expectations. But if you measure it, for instance, in that score, so taking into account the low volatility, you can see clearly that they've moved up and they've not come down. So yeah, definitely a risk.
And Trump, recently he's been talking about how interest rates are too high, and historically, he's wanted low rates just over his career and in the last administration as well. So, I mean, do you think there's a chance that he will somehow influence the Fed or force the Fed somehow to cut rates?
So in terms of forcing the Fed, I see limited scope. Remember, the Fed is run by a lawyer, and it's clear from his communications that He's well aware of, the legal protections afforded to the Fed. He also has spent years cultivating a relationship on Capitol Hill and doing anything that would fundamentally undermine the Fed independence would probably require a law. The law in the US, we have this strange system called the filibuster. You cannot get, except for the budget, you cannot get anything through the Senate unless you have 60 senators. The Republicans have only 53. So the risk of, undermining in a very significant and lasting manner the independence of the Fed are probably low at this stage. The risk of influencing the Fed as well, because turnover is limited. We had the vice chair for supervision, Barr, who announced he was resigning as vice chair, but staying on as governor, which means the administration cannot, the incoming administration won't be able to appoint a new governor. So it's quite difficult to influence the Fed, and I think it would be counterproductive because one, the Fed is rather dovish, and second, one big reason Trump won was inflation, and so at some point, his advisors are going to tell him that if inflation goes up, he might lose the next election. And as you know, in the US, we have a very short electoral cycle. Next elections are in less than 2 years. So I actually think the conflict between the Fed and the administration, the scope for conflict may not be as big as commonly assumed.
Okay. And speaking of Congress, how do you think Congress or Trump and Congress will fare in terms of passing their fiscal plans?
So they will pass a fiscal plan because they have a majority in both houses, and a simple majority is all that's required. The question is, how soon? They are talking of early April. That would be the earliest date. To June, to mid-June. That would be for the final bill. We should get a sense of the deficit, the overall deficit spending and revenue number in early February. The biggest risk, which I think would be more with how long it takes to adopt the bills and adopting the bill. The biggest risk are internal Republican dissensions. They have a majority of 4, so they have 219 seats. The Democrats have 215. The Republicans are going to lose 2 representatives who have been appointed to cabinet positions. There will be elections, and I think one is replaced by the governor of Florida appointing the replacement. But this will take time. So Congress will pass something with Trump's priorities. We just don't know how big the hole will get. And there is an issue of whether it gets passed, when it gets passed, early April, or is it mid-year? But they will get something, definitely.
In terms of whether we end up with a positive net fiscal impulse, if it's simply renewing the Trump tax cuts, that's not anything new. It's just
right.
It's not contraction. And then he's talked about cutting taxes on tips and social security payments, so that potentially could be a net stimulus. But then there's tariffs on the other side. I mean, how much of a net stimulus will it end up being?
We don't know at this stage. Also, the tariff will have an impact on both supply and demand, in the sense that they will raise cost for everybody. but they could also raise revenue, which would, everything else equal, decrease the deficit. But the bottom line is we don't know, because we've heard a lot of conflicting stories. So yeah, not much we can do.
We'll wait and see. And
Yeah,
I guess once the
exactly.
inauguration happens on January 20th, well, then hopefully after that, we'll start to see more details of firmer plans. Now, for 2025, what are some of the risks that you're worried about on either side, both sort of positive risks and negative risks?
So obviously the policy implementation risk, I mean, depending on how this trade strategy is implemented, we could have a boost to growth, which, by the way, would be inflationary. But I have a strong suspicion that what the administration is aiming for is a sort of comprehensive deal with countries that have a large trade surplus with the US to decrease the trade surplus through purchases of American goods and services, which we will have then to produce, and I think will be inflationary. And also through more foreign investment in the US, which will also be inflationary, because for sure, investment in the long run increases the supply capacity of the economy. But on the other hand, in the short term, while you build all those beautiful factories, you are actually adding to demand for workers, materials, and so on and so forth. So the best case scenario for this trade policy is higher growth and inflation. The worst case scenario is the administration, countries play hardball. The administration can't extract any concession, and instead we get into a trade war, and we just get an increase in costs to US producers and US consumers. So that's one risk. And in general, the policy implementation, again, I mean, things like immigration, I really don't think they are going to do the mass expulsion. So it's a small risk with a big impact. Another big risk is with the treasury market. As you know, I wrote a tongue-in-cheek piece at the end of the year predicting a failed treasury auction. And this was half a joke only, because debt dynamics in the US don't look good. Also, foreign buyers have been, foreign interest in buying treasury is coming down. The share of the dollar in international reserves, especially if you include gold in this reserve, is really coming down. So if we had, for instance, an open conflict, say, between the Treasury and the Fed, the administration being seen as actively undermining the Fed, if the administration was trying to blackmail countries, and the blackmail turned out to be counterproductive, and so on and so forth, we could see foreign buyers, what's left of foreign buyers leaving the US, and a spike in yields, and that would have cascading effect across the whole funding structure, probably on the banking system as well. So this could be quite devastating. So again, I mean, and don't get me wrong, there are things that Trump wants to do, which I think are great, and I'm all for it, like restructuring government spending. And, he has a point about globalization not working out for the average American household. But the risk, so he wants to be a disruptor, and the risk with disruption is that, you can disrupt too much. So can you bring the disruption without bringing huge volatility, destabilizing volatility? That's really a key question for next year.
Okay, great. Okay, well, I think we've covered a lot of ground there, but the main message I can sort of see from what you're saying is that inflation will turn out to be higher. than people expect. And the Fed won't cut rates this year, which I think is a very sort of strong consensus view as well. So with that, thanks a lot, Dominique. As usual, it's fantastic to have you on the podcast show. And, good luck with all of your sort of research agenda that you have for this year, and keep up the great work.
Thank you, Bilal. It's always great to be on your podcast. What a honor.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.